Greetings, this is the latest video in our CrashWatch series of videos, and today we're going to look at the S&P 500 and the new events that have unfolded in this index since the last time we did a CrashWatch video, which was 3 weeks ago. So this is the S&P 500, and after a recent correction down to the 3580 level or so, is now back to 4,000. But as you can see, this is an orderly waterfall effect, a staircase effect, because it appears that the Federal Reserve manipulates the market to create an orderly soft landing, as they call it. So far they've been successful at doing that. I'm not a fan of the Federal Reserve manipulating the market, but at the moment that has worked, and that tends to work until it doesn't, but we shall see. But as you see this 5-year chart, that tells us where the market was in 2018 and 19. And longtime viewers know that I say the final bottom is in the low 3,000s. Now it has to hit that final bottom within the next 6 to 12 months or so. Otherwise the final bottom will be higher just based on the long-term trend line. However, the low 3,000s is still a relatively good price for anyone who is looking at it from 2017, 2018, even 2019. Ignoring all the events that occurred between the 2 points in time, telling someone in 2019 that the stock market would be in the low 3,000s in 2023 is a pretty good price from that point of view, ignoring all the extremes in between, which of course were caused by the COVID-19 pandemic and the Federal Reserve and other central banks responding to that pandemic with a huge amount of liquidity, which is the right thing to do, but now they're unwinding it, which they should not do. They should let it digest of its own accord. But the S&P 500 thus is over here and is in what we call a dead cat bounce or a bear market rally. This pattern would lead one to believe that it will then make another leg lower and then another higher and another lower. And it may take a couple of steps to get down to the low 3,000s. Now let's look at this correction a little bit more. So this is a 2-year chart of the S&P 500. So after the brief spike, it reached that correction bottom that we saw, short-term bottom, or other leg down, I shouldn't call it a long-term bottom at all, of around 3580 or so, and this rally over here. The market was mustering up energy to correct. We call that corrective energy, and that is exactly what we have seen over here recently. And there will be another leg in the near future, but not right away, because it used up all of its corrective force. It has to take some time to muster up another attack on the fortress, so to speak, and therefore accumulate the corrective force necessary to make another attempt. And to look at that, we look at another index called the VIX index to get a more precise estimation of all of that. So we go to the VIX index, and this is a 1-year chart of the VIX index. The higher the VIX index is, the more severely the market is correcting, because the VIX is a mathematical calculation of how much people are willing to pay for protection on the S&P 500. That protection takes the form of put options on the S&P 500, protection from it going down, of course. And there was a spike in May, as you can see here, and then a fall, meaning people have become less fearful and more complacent. And then another spike, meaning that a correction was occurring. The median for the VIX longer term is usually around 19 or 20. Therefore, when it's above 30, that means the fear level is pretty high and the market is correcting. When it drifts back down from there, that means the market is rising from the recent correction. It took a lot of time to muster the force to get back to 30 or so, as we can see. And the corrective forces attempted to break down the walls of the fortress for a good month, September and October, let's say. Then it ran out of energy and has to go back and regroup and muster more energy. That takes some weeks. That's why I believe that ultimate bottom of the S&P 500 certainly cannot occur in the next 6 weeks or so, despite the Federal Reserve tightening and all the Fed funds rate hikes that the Federal Reserve has done, which would take some months to work their way through the system. So the next attempt might be in January or February. That would take the form of one more leg down. Probably not a big capitulation. That's what they have been successfully preventing, because that would take the VIX not to the high 30s or anything, but to something like 75 or 80. And instead, if they're managing it such that the highest the VIX gets is 40 or 45, then they've engineered what is called a soft landing. But this is the VIX volatility index. One can even trade VIX futures, which is somewhat like a leverage bet on the S&P 500, but it's more complicated than that because you have to account for the changing ratio in VIX movement versus the S&P 500. Sometimes the VIX does not rise very much, even when the S&P 500 is falling. Sometimes it rises a lot for small falls. There are mathematical calculations around that I've taught in my class at Stanford. There are also VIX futures that represent further out months, but then those futures have contango and backwardation properties to them, and that's a complicated subject that I'm not going to talk about over here right now. Suffice it to say, looking at the VIX gives you an idea of when the fear is rising and when the fear is falling, and therefore when the fear may rise again, and thus when the S&P 500 may make a correction again, or at least another step down in the waterfall downward staircase effect. Now remember, none of these videos are recommendations to do any trade or not do any trade. This is just knowledge to help you learn about these fundamentals so you can make your own decisions. That's why these videos are going to be useful even years after the fact. It doesn't matter what happens in 6 weeks or 10 weeks or 3 months from this video in the marketplace, because the fundamental principles will still be the same, and someone watching this video in the future will also be able to learn about these principles of the S&P 500 and VIX and apply those learnings to the future as represented by that point of time. But this is how to look at the VIX volatility index as it relates to the S&P 500. Now, if you like this type of content, then I encourage you to subscribe to this channel, and thank you very much for watching.